Saturday, June 13th, 2020, Maneco 64, home of alternative economics and contrarian views. So today I want to talk about whether we can trust the Bank of England to teach people about money, to make them financially literate, as they put it, and especially children. One of my friends yesterday, I used to work with him in the city of London. He pointed out that the Bank of England had tweeted yesterday that they're going to team up with the Beano, a cartoon character, to teach primary school kids about money. And the FT has caught on to the story. They've written something today online. BOE teams up with the Beano to teach primary school kids about money. Dennis the Menace and other characters will feature in lessons dubbed Money and Me. So what do I think about the Bank of England teaching children, or anyone for that matter, about money? I think it's a dangerous thing. I don't think the Bank of England is honest about the monetary system, and I'll show you why in a minute. But before I go further, I'd like to make a couple of analogies that remind me of what the Bank of England is trying to do. The first one is if you had Al Capone and Meyer Lansky, two huge mafia bosses, of course, teaching courses on civic duty and law and order, right? That's the first analogy. The second one would be having Bonnie and Clyde help you set up your security system or alarm system for your bank or for your house, for that matter. So I like to start first with what money really should be. And I'm going to take John Exter's speech that he made in 1972 at the American Institute for Economic Research. And John Exter, some of you might know, he was actually a central banker. He actually helped found the Central Bank of Ceylon or Sri Lanka back in the 50s. He was instrumental in helping the Philippines get its own central bank. And yes, I'm not a fan of central banks, don't get me wrong, but if ever there was an honest central banker, I would say it would be John Exter. So I want to look at what he says about money. What is money anyway, as he puts it? Well, the first quality of money is that it's a means of payment or a medium of exchange. That's quite easy for us to ascertain, of course. The second is that it's a standard of value. So it makes it easy for us to value goods and services. We can take a 10-pound note and say that a pizza is worth 10 pounds. If we had, a pair of shoes, it would be difficult to know if that pair of shoes would be worth the same as a pizza. So it makes it easy for us to value things. And the third one, and I think it's one of the most important ones for the whole monetary system, and it's one that the Bank of England doesn't touch upon in some of its material, even a short video it made already for school children, is that it's a store of value. And as John Exter says, money holds its value if it is scarce and remains scarce. Scarcity is the keystone of store of value money. And I would say we don't have that anymore because the central banks are not making money scarce right now by creating trillions and trillions or hundreds of billions like the Bank of England out of thin air. So let's look at some of the material the Bank of England has. They've got a little video here, Pounds and Pence, what is money and how does it work? And I have to say they have a couple of or a few children talking about money, and a lot of what they say makes sense, but they never mention the fact that money is supposed to be a store of value. They also show one of these Bank of England notes. They actually point out that there's a promise to pay here, and that it used to be that you could take this to the bank and get gold. but that we're not on the gold standard anymore, but that this note is a promise to pay. It's based on faith on credit, but they don't point out what they paid this promise with. That's a red flag for me, and they never talk about the store of value, how can I say, aspect of money. They talk about barter, how it started, and how money facilitated the exchange, which is good. And they actually talk about how gold and silver were used as money, and how the goldsmiths actually started issuing these, that you could store your gold and silver with them. But they never talk about it being store of value money. And I want to look at the Bank of England inflation calculator, because it goes to the heart of this store of value question. And back in the 19th century, until the breakout of World War I, England or the UK was on a gold standard. You could take one of these to any bank, a £10 note, and you could get 10 sovereigns, because that's still the legal or face value of a sovereign is still £1 today. But if you wanted to get one of these today, you would need more than 300 banknotes. So the store of value is not there anymore. So let's look at the period between 1821 to 1914. And here I am using the Bank of England inflation calculator. And so I'm not using anyone else's inflation calculator. And I would say this is not really inflation. It's the cost of living calculator. We know, and I've said in many videos before, the definition of inflation, of course, which I've said many times in my past videos, is not rising prices. Rising prices are a consequence of inflation. In the classical definition of inflation, we know that it's the excess creation of money and credit resulting in rising prices. But nowadays, that definition has been corrupted in order for the bankers, the central bankers, and governments to fool people into thinking that there is no inflation. But as you can see here, when the Bank of England had sound money from 1821 to 1914, and why 1821? Well, that's when the Bank of England went back, or the banking system in England went back to allowing people to convert their notes into gold. There was a hiatus of about 25 years that convertibility was suspended because of the Napoleonic Wars. But as you can see here, £1 in 1821, in 1914, that pound cost 95p. Does that mean that the pound in 1821 was only worth 95p in 1914? No, that only means that you only needed 95p in 1914 to buy the equivalent of £1 worth of goods in 1821. So as you can see there, prices drop by minus 0.1. They call it inflation, but it's not. It's the price level. They would call that deflation, even though it's a tiny bit of deflation, right? So the store of value was very good for the money because it was real money. It was gold, right? And now we look at the period since 1914. Yes, Churchill, when he was chancellor, did put the country back on a gold standard, but it didn't last very long, a few years. So if you had a pound in 1914 and you saved it, or you gave it to your family or grandchildren, nowadays you would need 116.26 pounds to buy the equivalent of £1 back in 1914. So you can see that prices rose at an average of 4.6% a year. They call it inflation. That's not inflation. It's the rising prices. But be as it may, That's how they view it. So how come the store value function of money has been destroyed in England or in the UK? Well, because we don't have money anymore to discipline the bankers. We've got the bankers just issuing these without any backing. They say it's based on faith. They still keep the promise to pay the bearer the sum of nothing. And you can't even call it money. I guess that's why this paper promise becomes worth less and less. So I also decided to look at what the Bank of England says about inflation. So they have material on their website. It says how have prices changed over time. It says prices have gone up by 2% on average per year since 1997. Why did they take that year, 1997? Well, that's the year that the Bank of England supposedly became independent, that they've kept a 2% CPI or inflation rate as an average rate. It's their inflation target. And they also note that when inflation goes up above that level, they raise interest rates and vice versa. But I remember years ago when CPI was at 5%, they never raised interest rates. And right now there are no interest rates. And I would bet that if we went back up to 2%, they wouldn't raise rates. But I would say that 2% rate they talk about that they've averaged since 1997 is not really the rate. Am I saying the Bank of England is lying? Well, I don't know. I'm just looking at their own inflation calculator. So as you can see here, according to the Bank of England, inflation or CPI has averaged 2.8% a year. And on another page on the same website, they say it's only averaged 2%. And you might say, well, 2% and 2.8 is not very different. Well, it is when you're compounding it annually. And I would say if you've learned your maths, you usually round up from above 2.5 or 0.5. So 2.8 is really 3%. So does the Bank of England actually talk about what inflation really is? No, they just talk about rising prices. Here you go. They're giving the example of Zimbabwe. So let's read through what they say is inflation. Think of a shopping basket filled with things we typically buy. Inflation is the rate of increase in the prices of the items in that basket. Well, as we know from looking at the classical definition of inflation, that is not true. That is the consequence of inflation. And why did the Bank of England hide about this? Well, because they want to keep creating the inflation, the money and credit, the QE. So they have to fool you into thinking that the consequence of their actions is actually inflation, while they're the only ones that can create inflation. And how do they do that? Well, because there's no more anchor to real money, so they can create these out of thin air. And even the founder of the Bank of England, William Patterson, said so in 1694. He said, the bank hath the benefit of creating money out of thin air on which it earns interest, something to that effect. So I also found some information on their website about commodity and fiat money, basically gold. It says, what's the difference between commodity and fiat money? And I'll go through what they say about this. And I quote, historically, as trade increased through the centuries, commodity money such as gold and silver was used in most countries. In the 16th century, goldsmiths began storing gold coins for customers and issuing them with receipts. Well, it's these receipts, which could be converted back into gold on demand. And you could do that until 1914. But when the war broke out, all the commercial banks in the UK and eventually the Bank of England, they defaulted because it's like going to a restaurant in the winter and you leave your coat in the cloakroom and they give you a little ticket or a receipt. And then when you leave the restaurant, when you finish your meal, you take the little receipt or ticket and they give you your coat back. Could you imagine if they said, oh no, we'll just give you a new ticket. You can't have your coat. So that's what happened in 1914. The Bank of England doesn't talk about that. So this is what they say. Carrying precious metals around is a considerable physical burden. All right. That's about over 300 pounds worth of precious metals. It's a little coin. How can that be a burden? I think it's a lot easier to carry one of these around than 30 of these, don't you think, to put in your wallet? You can put that in your pocket. So that's another fallacy there. Over time, people started to use the receipts instead. These receipts became a form of money themselves and forerunners of the banknotes used today. Well, they're not money. They're not money. They're just receipts. That's another fallacy. And I have to say, even I fall into that fallacy sometimes because we talk about money printing. They're not really printing money, the Bank of England. They're printing receipts. We have been issuing banknotes for more than 300 years. For most of the time, banknotes could be exchanged on demand for the equivalent amount of gold. But the link between banknotes and gold, known as the gold standard, finally ended in 1931. Since then, banknotes have been a form of fiat money or fiat currency, money that is not convertible to gold or any other asset. So I would say it's fiat currency that is not convertible into money, gold, or any asset. Let's look at their conclusion. One advantage of a system that uses fiat money is that the amount of money in circulation can be responsive to changing economic conditions. I don't agree with that because under a gold standard, interest rates regulated the flow of gold or money. So that doesn't make any sense either. This can support the smooth functioning of the economy. It can't. How smooth have our economies been since 1931, especially since 2008? I would say not very smooth. By contrast, the total amount of money circulating in the economy during the gold standard was ultimately limited by the amount of gold that could be mined. That's another load of rubbish. The amount of money circulating in the economy had very little to do with the amount of gold that could be mined. It had everything to do with trade, with how well a country's economy was doing. Because the other fallacy is that under gold standard, if your country doesn't have any gold mines, you can't function in it. And that's not true because gold, as we know, is money. And if your country produces goods and services, other countries will want to exchange their money, their gold, for your goods and services. So that's what the Bank of England tells people. They don't really look deeply into things. So let's have a look at global gold mining production over the years. Well, actually since the early 1800s here. And this is from goldchartsrus.com. And you'd think that gold mining would be going really badly because of what the Bank of England said, that there's not enough gold being mined around so we can use a gold standard. But look at that. Look at that. And I would say that the Bank of England's target for CPI or inflation of 2% actually corresponds to the historical growth of gold supplies through history, which is around 2%, and actually also corresponds to the population growth, which is roughly around 2%. So this claim by the Bank of England that unless you have a gold mining industry, you can't have a gold standard is a total fallacy, because England wasn't a gold standard for 200 years. And it was never known to be a gold mining power. Yes, it had some of the colonies that had gold, but it had nothing to do with gold mining, because we know that all the gold that's ever been mined in history is still above ground, and that's why gold is money. the new supply of gold from mines annually make very little difference to the value of gold relative to other goods and services. And that's why gold is money, because it's such a stable store of value. And of course, the Bank of England doesn't talk about that. It just talks about what they call money now, this empty promissory note. They talk that it is means of payment, and that it works as a measure of value, right? And they're right about that, but they conveniently forget about the store of value. I think it's very dangerous that the Bank of England is getting involved in the educational system, especially for children. What would I recommend parents or anyone who wants to learn about money? Well, watch my videos. But seriously, in terms of books, I think this is the best book to learn about money if you want to know about money. It was written by Murray Rothbard, an American economist of the Austrian School of Economics. And it is this: What has government done to our money? It's a US focus book, but it works for any country in the world because we are all under the same system. So I highly recommend that book. It's even for children. It's easy to read. It goes over a lot of what the Bank of England says, but it doesn't omit a lot of the things that the Bank of England omits, of course. What else? Well, I would read about The Secrets of the Federal Reserve as well, about central banking by Eustace Mullins. And if you really want to learn about gold and the monetary system as well, if you can get this book, it's called A Pocketbook of Gold, A Survival Manual for Monetary Mayhem by James E. Sinclair and Peter Carlin. Recommend that as well. So by now you can tell how I feel about the Bank of England teaching people about money and inflation and things like that. So always ask questions. Years ago, one of the things that got me into looking at the monetary system was looking at one of these and looking at the promise that they have here to pay the bearer the sum of, and that raised red flags for me. And at the time I asked myself, what are they paying me with? So I actually called the Bank of England. I phoned them, their press office, and I asked them to speak to someone about their promissory note. And I asked them, I said, you know, your chief cashier, he signed the note and says, I promise to pay the bearer on demand the sum of £10 or £20. And I said, what do you actually pay with? And the person said, well, it used to be gold, but now we don't have a gold standard anymore. And I said, so why do you keep that promise there? And they said, well, that's if you bring in an old note, we'll give you a new note. And then I said, well, why don't you write that on the note, that you can bring an old note and replace it with a new note? And he didn't have an answer for me. So that in of itself just convinced me that this monetary system that we have is not fit for purpose. Yes, it's fit for payments. Yes, it's fit to value goods, to make it easier for us to exchange goods. But it's not money and it's not a store of value. So beware of the Bank of England teaching anyone, let alone children, about money. So if you enjoyed this video, make sure you hit the like button. Make sure you also share it far and wide so more and more people learn about this. And if you haven't subscribed to my channel yet, think about subscribing. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great weekend. Take care. Bye.